Okay, so ever since I did the presentation last October focusing on certain indices and seasonals, a lot of people have told me that they liked what I showed and they want to adjust their trading um, to that style because it seems to be more efficient and their focus was on making money. And that was all they wanted to focus on, making money. So as opposed to the excitement of trying to trade everything and being in everything, being in gas, being in real estate, being in silver, being in gold. They wanted to really get more focused and just focus on profiting rather than being in the mix with everything. So that's what I want to go over today and show you how that actually translates to reality and how I've been doing it and Becky's been doing it and other people have been doing it also to really fine tune their trading and focus on making money rather than more for the excitement of trading. All right. So how to reduce losses. As most of you already know, these are the sectors we trade. And I send out an email every day showing what's valid for that particular day. And there are people who trade all of these. There are people that trade whatever they want to trade. They just freely trade everything. However, when you do that, sometimes if you start picking up, you might be doing really, really, really well in one thing. We have just a nonstop string of wins, but then you're trading a totally different sector and there are losses happening within that sector trades and it offsets the wins you've been having elsewhere. Okay. So in the long run, it all works out, but you can actually get a little more fine-tuned and rather than trying to trade everything, get more focused. So that's what we're going to look at today. And I'm going to switch over to a spreadsheet here, some of which we've been updating and posting over the last couple of years. But it'll be good to see. And then, okay. So this is a spreadsheet of the valid trade. Becky updates this every 3 months. And we make this available to anyone who wants to see all the trades which have been valid so they can verify their wins and losses versus what we show as wins and losses. This is 2024, which has been an awesome year so far. This is through the end of March. Next update will come out next month. And going back to 2023, this is all the trade that were valid. This was the overall start stats, long trades and short trades. Okay. This is trading everything. Okay. So if you see here, you have all the wins and losses. And the reality is with options, we don't know how much we're going to make. That's why we maintain at 80-something% wins, because then we know we're always having 5 to 7 wins for every 1 loss. And then we will make money. But the reality is if you have a loss, then you're going to have several more trades to compensate for that loss because we don't know how much we're going to make on an option trade because pricing varies depending on how long it takes to get to the first target. It could be a fast move, it could be a slow move, it could go against you for a while and come back, it could gap. So all these different variables in option pricing. We know there's a good chance it'll be profitable, we just don't know how much profit. So, but we've been making this information available to everyone. But not everyone has been utilizing it as efficiently as they can be. So what we did last November when we were focusing just the seasonals, what I did was show everyone, what if we only trade a Dow, NASDAQ, and S&P, okay? And then people were like, wow, same information you have in this spreadsheet, we just sort through by grouping. So for this presentation, what I did was I grouped the indices, the Dow, NASDAQ, and S&P trades to show what those win-loss stats look like. We grouped the metals, silver, gold, mining, the mining companies, put that into one grouping, and also put the energy sector into one grouping, oil, natural gas, XLE energy, and we put those type of ETFs into one grouping So if we wanted to trade energy sector, then we trade energy stocks or ETFs. If you want to trade indices, you trade the indices. If you just want to trade the metals, you trade the metal ETFs and see what those numbers look like. So let's take a look first at trading the metals. Some people like to trade metals, silver, gold, and the metal mining companies. So just so you know, everything in a rectangle is done by Becky. She maintains all these stats, tracks all these numbers. But this is an overall summary, just trading gold, silver, right through the end of April. For 2024, we're at 84%. This is for 2019 through 2024, overall 84% winning trades for trading that grouping of these four ETFs, GDX, GLD, SLV, and XME. Those are all the metals. It's a solid 84% win since 2019. We do have stats that go back all the way to 2006 and from all the way back to 1999 and 2000 for the indices. But we just started doing this so people can see the wins and losses and compare their trades to what we find valid also. All right, so it's a very nice, it's solid 80-something% wins every year, trading that grouping of ETFs. Okay, that's just the metals. And then we did a breakdown, even a little bit more for the different ETFs. Here's GDX trades specifically. Here's GLD's trades specifically. So you can see, but that's all information you have available to you at any time on those spreadsheets that you can sort through and get the same information. Here's SLV trades and the win-loss stats, and XME trades, win-loss stats. Okay, and they're all solid 80-something% all throughout. Okay, this year there weren't as many trades, so it's 50-50. There weren't as many trades that year. But you can see the stats, but you can sort through this and find the best of the best for yourselves. When we took a look at the energy sector, that's trading UNG natural gas, USO oil, XLE energy ETF, and XOP oil producers. These are listing of the trades. And here are the overall win-loss stats each year for trading the energy sector. Once again, 80-something to 90-something, 70. It's kind of a range from upper 70s to 90-something% wins overall each year. Once again, we have the stats for the UNG, USO. And once again, this is all on that main spreadsheet that everyone has access to and can sort through. And it all looks really good. It's all in the 80-something% win rate overall. And it's great, okay? But now, some people just want the best of the best. And the best of the best has always been focusing your trading on a Dow, NASDAQ, and S&P. The Dow, NASDAQ, and S&P gives you the absolute best results from trading our option strategies. All right. So we have a listing of all the trades, and we added one more strategy for this past year. But take a look at what it looks like percentage-wise overall. 91% wins since 2019. 290 wins to 28 losses. Okay. Remember I said it takes you want to have at least 5+ wins for every 1 loss. Well, we have like about close to 10 wins for every 1 loss, basically. Okay, about 10 wins for every 1 loss, meaning it's extremely profitable trading just the Dow, NASDAQ, and S&P. And since last October when I did a presentation, more people have approached me wanting to just focus on the Dow, NASDAQ, and S&P. So we've sorted it out and want to show you what the stats look like. So even going back a couple of years, it's basically been staying in 90-something% wins. We had 1 year and 80-something% overall, but it's been in the 90-something% win rate each year, just trading down NASDAQ and S&P. Once again, that's 9 to 10 wins for every one loss. So, and all we need is really about 5 wins for every one loss to know we're going to make money, to know. So this is extremely, extremely profitable, just focusing on the Dow, NASDAQ, and S&P. So for those of you who want to trade everything, and that's what you want to do, you want to trade this, that sector, that's okay. But it just gets frustrating when you are totally crushing it. Let's take a look at this trade listing here. Let's say this was your trade listing from just for Dow, NASDAQ, and S&P going back to last August. Now, let's say you're trading some other sector, and that other sector gives you a loss right here, a loss right here, and maybe a loss right here. Those extra losses in there would quickly dilute your profits, okay? Because let's say you had these 4 winning trades or these 5 winning trades, and you had a loss here from a different sector that's totally unrelated. Well, these 4 wins are going to end up being what's needed to offset that one loss you just had. So you don't get the benefit of these 4 wins as far as real profit. They're just offsetting a loss from a different sector. But by focusing on the Dow, NASDAQ, and S&P, it really makes a difference if that's what you really want to focus on, to purely profits and not the excitement of trying to trade everything. All right.
Hey, Eversley,
Yeah.
just a question to confirm what determines a win. Is that based on 1 expiration cycle or 2 expiration cycles?
2 expiration cycles.
Okay.
All option trades are 2 expiration cycles. On the Donchian strategies and also the squeeze play, we put stats available for 1 expiration cycle. That is a business decision if you want to go with 1 expiration cycle. There are some people that have smaller accounts and they literally can't afford to buy options 2 or 3 cycles out or 2 or 3 months out. So they can still participate in the trade. They still have a good high win to loss rate percentage. However, there might be a slightly higher percentage chance of a loss.
Got it. Thanks.
Right. You know, all option trades are 2 expiration cycles. That is standard. That's how all this is based on. So it's a little bit higher upfront costs for the option because you need at least 2 to 3 months worth of time. However, you're going to have a lot fewer losses by having more time. So it's a trade-off. You can buy less time and have a lower upfront cost, but more losses, or you can buy more time with a higher upfront cost, but fewer losses. I personally prefer buying more time and having fewer losses. That's my preference. The percentage return doesn't really change that much depending on how you enter the trades, and we'll take a look at that in a little bit too. Personally, I average about 30 to 60% return at the first target on these trades, but that's because I don't rush to enter the trade the next morning. I'm very casual and relaxed entering the trade, so I usually get in a much better price than expected, have a much bigger target than expected. So I could actually take fewer trades and make more money, bottom line. All right, so let's take a look at our stats here again. So here is the overall stats for each year. For the Dow, 95% wins from 2019 to 2024, 93 wins and 5 losses. That's long and short using our strategies. Most of the people on the Zoom call right now, most of you are familiar with the strategies already, and we added one more, but most of you are already familiar with the strategies. If you're only trading Dow, that's 93 wins, 5 losses. You won't beat every trade. Some trade just won't be quite right. Open interest isn't right. Is just too far out. But you can see what kind of profitability you can have, even if you caught, let's say, half of these trades. Even half of these trades, okay, is just it's just money in the bank. It's just a constant ATM machine. And that's the term we used to use a while ago, because some of our strategies, we used to call them an ATM trade because it just constantly create cash flow for us. Just whenever we need it, we trade this. We know we're gonna make money off it. It's just cash flow trades. That's what all this is. 2023, a little bit lower in 22, all wins in 2020 COVID year was like the best year of trading ever, best year of trading. And it goes back to 2019. And the stats don't really change going back to further years also. Here is the Qs and S&P. Similar numbers. Very high, very few losses. Okay. So I've had people I've been working with and they tell me that all looks great, but we have smaller accounts and we can't afford to trade the Dow options. We can't afford to trade these options. It just costs too much, because some of these options at certain times can range anywhere from $900 to $1,800 for one contract, depending on market volatility. That's been the range between $800 and $1,800 for one contract, depending on market volatility. And that's okay. There's always a choice. The reality is, the more money you have, the more opportunities you have to do well. Just like in regular society, those who have more opportunities at different things. Same thing with trading. If you have someone with $100,000 account will have more opportunities than someone with a $10,000 account. Just the reality of it, okay? And if you have $1 million account, the world's at your doorstep for whatever you need for trading. But you can take similar trades, but you have to, if you have a smaller account, you have to really pick and choose. Bigger account, you don't have to be as selective. You can trade what you want when you want, because you just have the capital. So that's the benefit of having the capital. Okay, so for those people who have smaller accounts, you may not be able to trade DIA, QQQ, or SPY. And that is why we also trade XLI and XLK. Okay. XLI is about 93% correlated to the Dow. It's the industrials. XLI is about 93% correlated to the Dow, and so is XLK, the tech sector, technology, is heavily correlated with the QQQ. So these are the stats for trading XLI and XLK. So some people who can't afford to trade DIA because the option just costs way too much, way too big for their account, XLI is an alternative to trading. Okay, so you can see what the numbers are looking like here. Still pretty good. Not quite as good as trading DIA, but still really good. Okay, and same thing with XLK. The options are much more reasonably priced, and most people should be able to afford to trade either XLI or XLK. And if you can't afford to trade XLI or XLK, well, then you have to do a different sort and go through some of the other ETFs that are lower in price and focus on those. Maybe group those differently. You can also trade the building and real estate sector with IYR and XHB and XLB. So there are always other options out there that you can trade with different sectors that might fit in with, or ETFs that fit within your price reality. So for smaller accounts, XLI and XLK are perfect. And I do a lot of XLI and XLK because I can buy more contracts than paying for DIA or SPY or QQQ, but get the same type of results. When I have more contracts, I can actually scale out of it. I can sell part of my position and trade and trail stop. So that's why I like trading XLI and XLK. All right. Let's see questions here. Okay, on the chat window, I just put in the link for the handouts. Okay, so if you want to print it out, I will also be sending a copy of the video out later on, and For those who are already coaching clients, email me later and I will send you the spreadsheet directly. So if you want the whole spreadsheet, just send me an email later. You already know how to contact, and I will send you the actual spreadsheet that you can sort through and make sure you're up to date on the spreadsheet. But the video will be available later on. But yes, because I know someone just asked about printing it out and where is everything. Link is all to the handouts is there. And if you want the actual spreadsheet, just email me later and I'll send you the spreadsheet. All right. Any questions so far on how to just focus on getting rid of the losses? Because this is how we get rid of the losses, is to focus on a particular sector, where the best one, we took a look at the metals, and you got a breakdown of each of gold and silver. And when you take a look at that, you can see that since at least in 2019, silver has been overall more profitable than trading GLD. Also, silver is, the price wise, it's very tradable. So, and for the energy sector, so I know some people really like to trade oil. When you take all the info out, you can see, as long as you're consistent, what the numbers look like. And USO has been excellent, except for 2023. We had more losses. And I know someone who really liked to trade USO. It was so funny because they would, USO had more losses than anything last year, but everything else had lots of wins. And this one person, unfortunately, that's what they would keep trading, is USO. They picked the one ETF that had the most losses. But that's the way it is. Luck of the draw sometimes. You just happen to choose the one that had the most losses, while someone else just happened to choose the one that had the most wins. But that's the way it is. You know, everyone trades what they want to trade, and hopefully it works out in your favor. But as long as you're consistent over time, the numbers will work out in your favor. You just don't give up. If it's a loss, as long as it's a valid loss, that's okay. Just do not give up on your trading. Check with me to make sure what you're doing, you're on track. Losses happen, that's okay. As long as you're doing the right thing, following the right plan, following the right trade management, and it's a loss that should have been a loss, that it's fine. It might suck a little bit, but it's a valid loss, and over time it will normalize, and the profits will eventually outweigh the losses, as long as you keep trading and consistent with it. All right. So let's go back to our sectors. All right. So any questions so far on any of this, on how we narrow down and eliminate to reduce to eliminate losses, at least due to expiring worthless? Okay. Well, let's take a look at how we can take a trade and how we actually get the most out of it. Because if you just trade things normally, it'll be usually a 10 to 30% return to first target in most cases, in that range. I'm going to switch over to the chart now. Okay. And let's go to a trade that was valid. This one that goes against you. These are always the ones that kind of suck, the ones that just go against you massively. And then you think it's going to be a massive loss, and then it ends up gapping and turning out okay. All right, let's take a look at this. I want to take a look at a trade that went against you from minute one. This is a trade strategy we usually go over in the presentations, is the Donchian cross. Okay. That's when the orange line crosses over the blue line. There's a Donchian mean line crossing over the 40-period moving average, the blue line. Okay. On this day, the orange line is 446, the blue line is 447, hasn't crossed yet. One day later, it crosses over. I know that we have at least about an 85, 90% probability that within 2 expiration cycles, the price is going to go higher by at least 1 ATR. Okay. For this particular trade, let's say you got in the trade the very next day at the open, it just goes against you, goes against you, goes against you, okay? Within 2 expiration cycles, it comes back up, gaps up. And some of these trades that you think is going to be a loss because let's say you paid $8 for the option here. By the time it's down here, it's probably worth 50 cents, maybe less. Then it starts coming back, coming back, coming back, coming back. And then here, and then what happens? The gap, and suddenly it's like an AED on your trading account because it just zaps your options back to life. They're back. And what you thought was going to be a full loss down here, all of a sudden is actually in the green and making money and rallying hard upward. Okay. Well, let's take a look at this now. Let's say you paid $8 for the option somewhere over here when you got the valid trade. Orange line crosses the blue line. That's just trade signal. Everything else is valid, looks good. So you don't expect it to go down, you expect it to go up, but expect it to go up within 2 expiration cycles, which is going to be about 2 months. This is going to has to be by the 17th. The 17th would be 2 expiration cycles. By this date, it has to hit the first target by this date. So entering the trade here on the 18th has to hit, should be the, let's see, 13, 14, 15. Yeah, entering the trade on the 18th, valid here, enter the next day on the 19th, and it has to hit the first target by this date, November 17th, which is 2 expiration cycles later. And it does. And it was actually profitable because of the gap. The gap makes a big difference, and then it rockets up. Okay. So what happens here? Normally, we would expect like I said, a 10, 15, 20, 25, maybe even a 20, 25, mid 20 something percent return at a first target. Let's say it waffled sideways for a little bit and went up to the first target. 20 something percent return is 15, 20 something percent return is reasonable. But there are people who I know trade these strategies that they have to get in the next day. They have to get in the next day at the open or below. But they have to do it the very next day. Okay. They get in and you put the trade on, that's perfect. And it goes against you and it comes back and you'll get a little bit of a profit. Personally, I don't do that anymore. I'm much more relaxed. I'd rather for the trade to pull back a bit first. If I miss the trade, great. It could open the next day and take off without me, great. But I look for this type of move. I just don't trade it. I just see if it pulls back. If it pulls back, hey. So for me taking this same trade, I might be getting in here sometime this day. Okay. So instead of having a target, take a look at the ATR here in the data box. My 1 ATR target might have been $3.99 from this point. But if I get in 3 or 4 points lower, because instead of getting in the next day at 442 where it opened at, I got in lower that day at 432, 438 something. So instead of having a 399 target, I might have a 7-point target because I got in down here. I take the exact same trade, but instead of a 4-point target from this point up, I now have a 7-point target. That 7-point target, when it reaches my first target up here, is going to be worth a whole lot more than if I only had a 3 or 4-point target. I'm now looking for a move deeper in the money. Let's see, 442. It would be getting me out somewhere here in the 450 neighborhood, 449, 450. So the original target would get me out right where this day opened right here, around 446, 447. A revised bigger target would get me out higher up with even more profits. Exact same trade. Let's say I was on vacation, I'm doing other things. These trades happen all the time. So let's say I'm doing other things, I'm not paying attention, whatever it might be. I don't even get back to my trading until over here someplace. Okay. I look back and I see, hey, I had a trade valid back here, but I didn't get into that trade yet. It hasn't hit the first target yet. But instead of getting in at this open price here, which was 442.68, let's say 442, I'm now down here at 422. I'm 20 points lower. I could have gotten in, if I follow the plan, I got in at 422, excuse me, at 442 up here. But I didn't even look at this trade because I'm doing other things or didn't have whatever. I just never got to it for whatever reason. Now I'm looking at it when it's at 442. 20 points lower. I can take the exact same trade. Instead of having a 4-point target, I can now have a 24-point target. Okay. What do you think an option is worth 24 points in the money? You don't even have to hold it for the full 24 points. You can get in down here, write it up for 10 points, take profit. Close it out. You got in down here. Instead of taking a 4 points, grab a 10-point move. Don't be greedy, trying to get the whole 20-something points. Get half of that, grab 10 points out of the money, take your money off. Then you see, hey, it's going down again. This trade back here is still valid. This trade is still a valid trade to execute on. I can get into this trade here, any place here. I can get into this trade, this trade is still valid. Okay. So I can get into the same trade a second time. This is what myself and Becky used to do quite a bit. Not sure if she still does the multiple trades based on one signal. But you get it, pulls back, you get in down here, write it up 10 points, 8 points, whatever it might be. Now it's subjective. You can do whatever you want. Grab some profits, get out. If it keeps going, great. Or grab some profits, get out, and get back in. The reality is you catch a nice 10-point move here and you get some more options, you're close to having a free trade because the profits you got from this move can actually pay for options you're going to be buying again. Okay. You use profits from this first trade to get in again, and the profit from this first trade you can get in again if it pulls back, or even leave it alone if it keeps going, great. But you can get in again. It's the same trade. Write it up, take another 10 points of profit, get out. Or if you're feeling good and greedy, leave it alone and grab 20-something points worth of profit. It's just the first target. Okay, this is how we trade. This is how we take our regular trades where we might get a 10, 15, 20-something% return to first target and actually make big returns on it. Take a look at the stats for the Dow, NASDAQ, and S&P. That is where you want to do it because the win-loss percentage is so high. Even if it goes against you, there's a really, really good chance it's going to come back and hit your target for a massive % return on your options. Okay. It doesn't tie up much capital because it's options, but you can quickly double your option value to triple your option value as this rockets up. you get him options. Hey, by the time you're reaching here, it's doubling in value. Okay, so we always buy in the money options anyway. But this is how we really capitalize on trades going against us. We don't try to trade everything at once. So I don't jump in. If I have this trade valid here, zero chance I'm getting in the next day unless if it takes off without me and I miss it, great. Wait for the next trade. However, I'm going to see a pullback and then I might get in here or here is where I might get in personally, and then wait for it to go up, and I'll still going to be 7, 8, 9 points in the money rather than 4 points in the money for my first target. And that's how I do it. But you don't have to rush. Always take a look at what trades have happened, because you might be looking at stuff here and then look back and see, hey, whatever happened back here? There was a valid trade then and hasn't moved yet. The more you track those. So Ken's asking a question, just in tracking a valid trade or what happens while we aren't paying attention. Absolutely. Becky tracks those every day. Becky tracks those, what's has triggered, what's been valid. So she keeps track of those for her purposes. So she can go back and see, okay, that's like I took a trade this past week. It was valid a couple of weeks ago. And I just finally took it because I found it was a good time for me, in my opinion. I'm going to take a trade now. Take a look at that. I'm going to switch to XLI. For those of you who get the email from me, it was on April 24th. You guys got a sell on April 24th, I think it was. Anybody got a sell signal? April 24th. This was the sell. It was the squeeze play sell. Squeeze play sell was valid on April 24th. It's like 90-something% winning trades. Okay. And it hasn't moved yet. Okay. I got into that trade up here at 125 something. At 125 something is when I got into that trade on I did that on Thursday. I got into that trade up here. So instead of getting in, the trade is normally at the open or below. So I should have entered at 121.41 or higher for a short trade. So at the open, I need to get in at or above this opening price this day. So instead of getting in at 121.41, I got in at 125 something. So I got in 3 points higher than I would have if I'd taken the trade on the first day. If I'd taken the trade on the first day, my target would have been $1.83. That's 1 ATR. Okay. Now I can have getting in 3 points higher. Instead of having a 183 target, I can have a $4.83 first target from up here, which is actually more than the cost of the option, which is actually way more than, so it's guaranteed to be profitable. And I have until July for it to reach the first target. And I'll probably take profit sooner. Like after it drops about 3-4 points is when I'll take profit.
What criteria are you using to delay your entry? Given that you had a signal, a buy signal,
Yeah.
but you said, hey, I want to wait. I want to wait until something, because I totally understand what you're doing, and you're certainly you can even see by the indicator at the bottom, but what criteria are you using to help you? And then also, what would you teach others to perhaps, hey, maybe it's wiser or more advantageous to delay entering the trade until price changes? That's the one thing that I think others would probably appreciate. But I totally understand what you're saying here. But I'm curious, what criteria are you using, or what indicators are you using to say, okay, I'm going to wait until X, until now I'm going to enter the trade?
Well, the objective way of trading, here's our trade signal on this day. The entry is at or below that open. That's the objective answer. Anything above this price is icing on the cake. Now, over time, I have grown in patience over time, because I know I have people trading this strategy who would have gotten in up here someplace. They literally go get to their computer the next day, and they wait for it to go up a little bit, then they get in. And that's fine. But they would have gotten in this day. Okay, let me get a price on this. This is, for me, we were having a massive bullish move going on, and this had just pulled back to support levels. And I was expecting this to bounce higher. Just other technical analysis knowledge. Let me see if I can change charts and show that elsewhere. Hang on a second. See, that shows up someplace. Let's see. There's a weekly chart, and let's see if I go. Switch back. Once we have our trade signal, as long as you are above this entry, it's a subjective thing. I'm not looking at any particular indicators. I'm just waiting till the market takes on a more, I see, our ETF squeeze signals, right? I saw the ETF squeeze signal happening. That is one of my major things. We got the ETF squeeze signal happening. The new ETF squeeze involves the Bollinger Band. The old version, we didn't use the Bollinger Band for the older version. You take a look back 2019, you'll see ETF squeeze 2. That's one we didn't use the Bollinger Band. The Bollinger Band made it a little more efficient, remove some of the fake outs, but I look at the squeeze rolling over. So if I see a sell here, like I said, I'm in no big rush to get in. I'm 90% of my trades are on futures. Realistically, 90% of my trades are on futures. I take the index option trades, the best of the best, when they come up. So my focus was on futures. For June, I'll be doing more options in June, because there'll be less futures trades in June. So June will be more options. So everything is a balancing act. But I was basically looking for the squeeze to start rolling over. And that's up here. So I was rallying, I saw it was rallying. We were in a bullish mode. We were bouncing off of a big uptrending support levels. So I wasn't stressing on getting short right away. The long trades were in play. But once I saw it rolling over with the squeeze, that's when I said, hey, it's time now. I'm getting at a much better price than expected. I still have 2 months worth of time, literally 2 months worth of time for it to roll over even a couple of points. So I got in at 125 something. I think I have a target set at 122.50. That's literally my target I put in. That's right about here. That's not even down here. I'm being conservative. My original target is going to be down here someplace around 120. That's my original target, is down here. I'm being conservative and being smart. I'm not being greedy looking for my original target. I'm being smart. I originally had a target that was $1.83. Now I put in a target that's a little over 3 points. So I'm going to catch a nice profit. The options cost like two something a contract, and I have a $3 and something cent target on each one, first target. So
Hey, Everly,
yeah,
this is Ken.
hey Ken.
Hey, what I would say, tell me if you think this is true. One, you and your partner have a lot of experience trading markets for 10, 15 years. And to me, it seems like you're synthesizing information that your experience in the past,
Yeah,
as well as through the valid signals that you've taught us.
that's correct.
And what I'm saying is that I look at the blue line here, which typically for you, I think that's a 40 moving average, simple
Yes.
moving average, if I'm not
Yes.
mistaken.
Yeah.
And so in looking at this, earlier in April, you're seeing price above that, which is a typical bullish thing. And when a market has been bullish for an extended period of time, you should expect it to retrace, take a pause, however you want to put that.
Yeah.
And you see that happening, and then you get this squeeze sell signal on April 23rd. And like you say, a lot of your experience, you've learned to be a little bit patient because, hey, it's been bullish for a long time. We're coming into summer. Seasonally speaking, that's something that happens on a seasonal basis. You got percentage numbers that back all this stuff up. So it's important. One of the things I've learned is important to understand that what we're doing is we're making a bet. And if you can get the better odds, it doesn't mean that you're right, that you put it on up at 125 or 126 or whatever it was, but it's a better bet. It's a higher return. And if you're wrong, but you're wrong with a smaller amount that you bet. And that, to me, a lot of the stuff I've learned from you is stuff that you've assimilated over time. And it can be difficult to not only verbalize, but to document. Is that valid, what I'm saying?
Yeah. Let me try to even say this a different way also for this. Part of it is experience and patience, which we don't always have. I said we got some people who I've taught this to, and they will get into this trade the very next day, but not at the open. They're going to get in if they'll wait till it goes up a little bit, then they'll get in. So they may have an extra maybe 50, 60, 70 point advantage, or 70 cent advantage. Great. Objectively, this is the entry price right here. Like I said, over time, the patience thing happens. And if I wait, I might miss a trade where I could have gotten, let's say, a 15 to 20% return. But by waiting patiently for what I call a better opportunity when the markets start to roll over while looking at the squeeze, now I can take this exact same trade and get a 70 to 80% return. I can trade fewer contracts and get a bigger bang for my capital. I could trade the same number of contracts I would have gotten down here and have one trade here being the equivalent of 3 trades one win from me getting in up here is the same as placing 3 trades getting in at the open.
Sure.
So I don't take as many trades anymore because I wait for the ones that would have gone against me. Like the example I went through earlier where the market went down, 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 down. Those are the trades I more often take than the ones where I get in right at the open the next day. I
Sure.
wait for the trades that go against me, my position, and get into those trades, but only on the Dow, NASDAQ, and S&P, because even the ones that are going against my position, 90-something% of the time, they will reverse and hit my first target within 2 expiration cycles. So I'm very confident taking the trades that go against me because I know I'm going to get a much, much bigger return on my money than if I had taken the trade right there at the open. As far as when to get in, I usually look for a signal like this is rolling over. Okay, or the other direction, the same thing, turning up. I need something to give me, or when we get, well, let's say I got a buy signal here and I passed on it and it kept going down. I'll wait for the next buy signal further down.
Okay.
And then get in there. It's still the same trade. It's nice something, but I'm now getting in a better price and I have more flexibility. Like I can take this trade here, like I did on Thursday, grab 3 points of profit, hits the moving average, bounces back up. I can get in again and take several points of profit. It's still the same trade. This trade is still on, but I can capitalize. This can pull back in the next couple of weeks or a week or two, pull back, grab profit, rally up again. I get in again, and I have till July to do that more than once.
You know, I heard a couple of older traders say that markets are really forgiving and that if you miss a signal, it'll give you another opportunity
Yeah,
to get the trade on. And
Yeah,
that's the patience that you're talking about.
exactly. This is the trade. But from this trade, I could have gotten in up here, grabbed a couple of points of profit. If you are greedy, then you want the original target. If you are smart, you grab a couple of points of profit and get out. Put money in the pocket. It goes back up again. Get in again, grab a couple of points of profit. Goes up again. Get back in again. Like I said, this is what myself and Becky have done for a long time by just literally this way of trading is to multiple trades on the same signal. Because the trade's still valid and the market just goes up and down. It's just cash flow. Once again, cash flow, cash flow, cash flow. Learned a lot of this also from Hubert Centers and John Carter, watching them trade this type of thing live when markets, there's some volatility and swings but yeah, it works really well, but it takes a little practice, but
Patient.
patience is really the thing, but that comes with
And
time.
also being willing to miss a trade. You alluded to that earlier. It's like,
Yeah.
okay, I didn't get that.
Yeah, once you realize you just wait a day, not a big deal. Most of the trades will go against you a little bit. And that's kind of, they don't just there will be some trades that just gap and go. They take off without you. But most of the trades will go against you a little bit. And you get in when it goes against you is when you get in. And that'll give you a bigger target than originally planned. Let's go back a little bit randomly. We're looking at XLI. Okay. We can pull up Dow, DIA, QQQ. Go back a little bit. We have a trade signal. Here's one that's just a gap and go. This is the same Donchian, orange line across the blue line. It gaps up, it just takes off. There is no real pullback. Okay. You have a little bit in the morning for it to pull back a little bit that morning, but then after that, it just takes off. if you're waiting for a pullback, you ain't going to get it. You missed the trade. This was an example. If you wait, you're going to miss the trade. And it's like, that's what it is. It's just a gap and go. It just took off. But there are other times when you have your trade signal and the market pulls back a little bit for you. At least for a couple of days, you get it at a little bit better price, not a big better price, but a little bit better price. Let's see, ATR is $1.43, 143. You got a couple of days to get in there. I'm only looking at Donchian. Another one, crossover. You have 1 day to get in because it just takes off pretty much. You got a little bit of 1 day to get in, then it takes off. Here's one where you have a couple of weeks for it to get in. So you got your valid signal here. You're getting in up here, and then, but you have, it pulls back, pulls back, pulls back. So you can get in here and your target is going to be hit over here someplace. But you have a couple of weeks to get in to this trade, and you have potential big returns. Instead of having a target that is $1.08, you can have a target that's $2.08 or $3.08, just depending where you get in. And instead of having a 15 to 20 something percent return, you have a 40 to 50 to 60 something percent return. It's gonna, because you have that much a bigger target, you're several points in, several strikes in the money.
Let
By
me
the time
ask
the
this.
target's hit, you're going to be at probably a 70, 80 delta or higher.
Let me ask this question. If you're one to get in immediately on the, when the signal's been validated and you get
Yeah.
in and it doesn't go your way, but it's early in the length of the trade, in other words, in the first week or so,
Yeah.
like the example you were showing earlier, and it pulls against you, do you guys ever suggest getting another, like if you only trade one at a time?
Well, look at it this way. If your standard risk allocation is $1,000 a trade, and let's say the contracts that cost 300 something each.
Okay, I see what you're doing.
Let's say you had only gotten 2 contracts. Scaling in, let's say you only got 2 contracts. Because you didn't want to miss the trade, but you still want an opportunity for a better entry. Another way is to get in a partial position early. So if it just takes off without you, if it just takes off, you're in the trade.
Right.
But let's say you wanted to scale in, and I'll use the term scale in. That's what I learned from John and Hubert.
Yeah, yeah.
To scale in, you get your 2 contracts at $300 each, so you spend $600. You're in the trade, but you still have 1/3 left that you can get in at some later time, without exceeding your $1,000 per trade risk.
Correct.
Your max is 1,000 something a trade, but you still have another $300 something that you can get in at a later time if it pulls back and you get in a much better price. And that one contract that you got in at a better price will probably make more than the other 2 combined.
Now you're a trader. That's trading right there.
That's trading. That's the fun stuff, because that one contract is going, and you can hold that, because if you're getting in that one contract down there, you got in the first 2 up here, you got in the other one after it pulled back, the market goes up, hits the target, these 2 are out. This one, break even is down here. You can put a stop loss in any place here and see how much you can milk out of that. That can be the big win. Just trail the stop with a loose stop. You already have lots of profit locked in. Just keep a loose stop. That's the one that can triple, quadruple if you have a nice open-ended target, or have a target that's just huge, so that if you just get in this, then you can get out when you feel like it. But those are things, are choices. And once again, the more money you have, the more you can do that type of stuff in your account. But that, it would be how you do it. So you don't go over, if you're risking $1,000 a trade, you don't go over that by getting another $1,000 worth of options. No, but you can choose as a part of your plan. Like I did this in October. October is when I actually did what you just said, was October. because it's October is when we expect a big move. So I held back a little bit to see if it pulls back a little bit, because those are the good trades in October. But yes,
Thank you.
you can do just that. All right. Okay, so let's see now. That's really what I wanted to focus on for today, was how to reduce losses, and that's really is to focus on the major indices, well, at least with our strategies, because they're really set up to give you an extremely high win to loss return percentage. So I know there are people who do trade Dow, Nasdaq, S&P plus everything else, and then that frustration happens up. You're doing really well, and then you have this one loss that wipes out all these wins, and then you win again, then another loss that wipes out all these wins. That's frustrating. In the long run, you will still make money, but it's just annoying when that happens. So I always go back to, some of you already seen this spreadsheet, I'll show it again. When one of my coaching clients was working with me, and let's see if I have that still here. I'll pull it up. Let's see. Thought I opened it. Oh, here it is. Okay, hang on a second. So I'm going to share. Some of you have seen this. This was from 2014, but percent returns don't change over time. So these are all the same type of trading. This is one of my coaching clients. Some of you know who he is. He was so proud of his trading. He shared his live trades with us, and this was not even optimal entries. This was getting into the open each day. A trade was valid. This is literally what he did. He got into the open each day. A trade was valid. Not getting in on pullbacks, okay, anything like that. He risked around $1,000 on calls, and between $500 and $1,000 per trade on puts. It was a $100,000 account. He was only risking less than 1% of account per trade. The goal is to risk 2% in that neighborhood. And so he documented 7 months of trading. And this is literally what our year is looking like right now, just getting in with worst case scenario, just right at the open. This is what he did, just get in at the open and place a trade and walk away. He did some few trailing stops, but you can see the money made, percent return, and did this for several months. One thing he learned, and he did really well, if a trade is meant to be a 1% return, it's meant to be a 1% return. Don't try to move your stops. Don't try to move everything around. Don't try to be in a little bit longer. Because when you try to do that, or you have a slight negative, well, I'm going to hold it a little bit longer till it goes positive. No, it just don't do that. If it's meant to be a 1% return, it'll be a 1% return. If it's meant to be a negative 2% return, it'll be a negative 2% return. I know there's people on this Zoom meeting right now who have been here with this type of situation, where they were down a little bit and they're going to hold it a little, they're going to hold the position a little bit longer until it went back positive, because they didn't want to lose any money. So, and it just kept going more negative and more negative until they had a full loss. So instead of taking, like, say, a $20 loss, they would have taken a $1,000 loss. The people I know on this call, on the Zoom meeting, who have done that, that's a learning curve. Whatever the outcome of the trade is meant to be, that's what it shall be. And all these trades were with 2 expiration cycles. And when you eliminate losses, these are the kind of numbers you get. This is at a 1% account risk over 7 months. Okay. That's what happens when this is what the numbers would look like trading like the Dow, Nasdaq, and S&P and nothing else. Now, if you trade everything else, there will be more losses. So he kept trading other things, so there were more losses later on. But focusing on Dow, Nasdaq, and S&P, this is kind of what it looks like. It just adds up really fast. Some people will think, well, it's only a 2% return. Yeah, on this trade, but 2% adds up and adds up and adds up really fast when you have, especially when you have no losses or very, very, very few losses. That money adds up faster than you think, and it shows. Okay, and this is only a 1% or less account risk. If it was a 2% account risk, then this would have been $34,000 net profit over 7 months if it was a 2% account risk. 3% account risk would have been 47,000 with a 100 grand account. But I don't usually recommend risking more than about 2% account risk. That's the max goal. That's not the goal risk. Smaller accounts, you end up risking more because of smaller accounts, but eventually that's what you want to do. All right, but this is kind of what happens when if you focus on the Dow, Nasdaq, and S&P. Okay, now if you start including everything else, it'll be extra losses sprinkled in. So then you get a minus 1,000 and a minus 1,000. You can have, let's say you have 5 more losses because of other things, minus 5,000 from this number. That's kind of that goes back to reality again, but still extremely, extremely, extremely good. But focusing on Dow, Nasdaq, and S&P is the best grouping, and to really minimize trades that expire worthless, and to get the most out of your call and put options, just buying calls and puts. So I put in here those same stats for the Dow, Nasdaq, and S&P. So you have that to take a look at. It's on the spreadsheet is on our website. Here are just a handful of trades that's been valid over the last couple of months for just Dow, Nasdaq, and S&P. I don't include the XLI and XLK on this one, just DIASPY and QQQ for this one. The squeeze play, buy and sell, is the newest strategy we added. Extremely, extremely, extremely high probability trade setup based upon a strategy learned back in 2005 or 2006 from the people we first learned trading from. That would be like Price Headley and David Elliott. The strategy was based on stuff from them, and then applied that knowledge to techniques learned from John and Hubert. So combine that knowledge base to create that strategy to squeeze play, buy and sell. Extremely, extremely high probability.
Eversley?
Yep.
Hi, this is Olga.
There we go.
So sometimes you will have both, like IWM here, a short and a long.
Yeah.
And because it's based on a weekly, so you're thinking long term, you're going to be holding it long term, and then the short squeeze is very short.
No.
I think
no. It just means, you mean like if we have a
time-wise,
you mean like if we have a buy on a daily chart and a sell on the weekly chart, that type of thing?
Yes, yeah. Sometimes you have the same symbol, but you have the opposite happening at the same time.
It just means that sometime in the next two months, the market might go down this much, or sometime in the next 2 months, it might go up that much. But you have 2 months, markets don't just move in one direction. Just that we got our buy or sell signal on this one time frame, the other one on the other chart. But remember, the markets just go up and down. So it just means that 85 to 90 something percent of the time when we get that signal, sometime in the next 2 months, there's an 85, 90 something percent chance the market will go down that much or go up that much. And if you get those type of signals now, it's actually perfect, because this is the time of year where we get that sideways to bearish type market. So, but yeah, it just means that it's within the next 2 months, not just one or the other. but within 2 months, it can happen. And that's just normal market flow. It goes up and down, up and down. And the reality is most of the time the market chops kind of sideways. It trends a couple times a year, then it just gonna go sideways up and down in a range. So it's gonna hit one, then hit the other at some point in time.
Is there any way that you know when it's going to ramp
Uh,
up
you have
the
to have
way it's been doing?
having inside information helps a lot. Other than that,
I mean,
October,
it's sometimes
October,
it's
that's
been
about it. Like
extraordinary,
just
crazy,
October, just October.
just expected in October.
Wayfall set of bicycles in October timeframe. That's the only time I can say like that's it, October timeframe. Not for futures so much, but for options, but October timeframe. That's the one we look forward to every year. I think there's only been 1 year that we did not have that big bull move. That was like 2015. We actually had like a massive bearish move. I had some people who were trading the strategies and they kept passing on the sell signals because they only wanted buy signals. And they were under the impression that they only missed a couple of the sell signals. So they didn't think much about it. So I had Becky put together a spreadsheet back then to show all of the trade signals, and there were 90 sell signals. Of the 90 sell signals, like 87 were wins. And they had passed on all those sell signals because they were just expecting the market to go up. But then again, that's why we trade our signals, not what we think or what we hope for. And they didn't realize they had missed that many trades over a several-month period.
So you said that for the month of June, because I know around July, market is usually bullish around July 4th.
Okay.
So in my experience. So in June, you said that you favor options.
Yes, because we have rollover and quadruple witching. So we're not going to be doing any futures. The charts are all messed up for our futures trades during March rollover and quadruple witching. Between the contract changeover and the charts are no good because the charts have gaps between the contract changes. So the futures signals are all off. So that's basically 3 weeks of time that we don't really do much with futures in March, June, September, and all of December. We take off. We can't rely on those signals. When you see our stats, remember the first line of the trading plan says no trades during certain weeks.
Mm-hmm.
That's why, because as the contracts change over, you're not even sure which contract to trade because you go to trade this contract, the platform will tell you that contract, you cannot enter any new positions with this contract. But the trade is on this chart with that contract, which you can't actually trade. See what I mean?
Mm-hmm.
So it's a problem. So the first 3 weeks in March, June, September, and December are basically, except for maybe the first couple of days in June, we got nothing for futures until after quadruple witching week, the third Friday.
The last two expiration days, usually the technicals are not supposed to be working on those days. And the last two, it's been a ramp up at the very end of it. And
Yeah.
I know some people say we don't trade expiration day.
Yep, that's correct. It's just different. Yeah, it's all being manipulated. It's not just regular normal market flow.
But the market moves really quickly one way or another.
Yep.
And one last question. The CBOE numbers that you get that we're supposed to look at, what is the significance that it cannot be between 0.85 and 1 point over 1 point?
That's for market internals, totally different topic than what we're talking about now.
Mm-hmm.
But that's for market sentiment, and that goes back to unusual activity in options that are at an extreme level.
Okay, so that is regard to sentiment.
Yeah. So that just shows there's a range where that's normal, but if we are above or below a certain level of with the put call ratio, then there is an unusual amount of option activity going on that can be correlate with one of our buy signals. So if you have a technical buy signal and an unusual amount of option activity going on at that level also, that could be a sentiment indicator to say, hey, there's something going on behind the curtain here that is also correlates with our buy signal. So there's something else happening here, that type of thing. So because those people who are in the know are placing option trades that we can't see,
Okay,
that type of
Thank
thing. So that's a different type of trading for the market internals.
thank you.
All right, cool. All right, so for anyone that's interested that hasn't been doing it yet, that wants to learn this stuff, let me know. Some of you are already doing the option. If you are already doing it and want to go over what you've been doing, make sure you're right on track. Email me later on. I can catch up with you and make sure what you're doing is correct. Otherwise, it's 1750, and anyone on the call today, I'll take $100 off this price. And this is for all of the daily chart option strategies, all the ones you've seen. And then once you learn the strategy, you can trade any of the ETFs with sectors with these strategies, and we'll give you the trading plan with this win-loss stats. Or you can choose to be more specific, just trade the energy ETFs, trade the real estate ETFs, trade the index ETFs, which is what we just focused on today with index ETFs, because those all give you the best results. If you want to have you dabble in oil and gold and biotech a little bit, and the NASDAQ S&P, you want a little Russell in there, you can do all this stuff. You want to trade some silver, you want to trade European, you want to trade Hong Kong, we have the Hong Kong ETF. You want to trade Germany, you can have the Germany ETF. So all that's there and tradable. It's fun, it's exciting, but it also puts in little losses here and there that can dilute the overall profitability. But if what you want to focus on is just making money, and your goal is making money, you can still have a good time with it, but you focus on the Dow, NASDAQ, and S&P, because that's where you make money. And a fun part is not having a lot of losses. Losses suck no matter how long you've been trading. It's no fun to lose money. And that's why I like trading the Dow, NASDAQ, and S&P as a group for the options, because I don't take many losses, just like the stats show that you have. The trades you see are the trades we have valid, and I send an email out every day showing the trades, and then eventually you can learn the analysis for yourself and do it on your own. But it works extremely well. Just follow Dow, NASDAQ, and S&P to really reduce losses and number of trades that expire worthless against you. Right, and all this is one-on-one. I do all this work with you one-on-one. Go over trades with you each day, or if you needed me, or once a month reviews, whatever it takes, and we'll just get you going on that. And if you want to do the weekly chart strategies, also it's $39.95. I'll take $500 off this price if you want to do both. If you want to do the this one plus the futures, which is the best combination, the daily chart strategies options plus the futures is really the best combination to do everything. And for that one, it's $17.45 for I will take if you want to do this one and along with the futures, it's $17.50 for the option, $17.45 for the futures, and I will take a total of 500 off the two of them if you're doing both. If you're doing both futures and options daily charts, I will take a total $500 off the combined price, because you'll be using some of the same charts and everything, so it's less time on my part to spend setting everything up. So I'll take 500 off the combined price if you're doing both options and futures. Just let me know by this Wednesday. And go on my website real quick, show you that. Some of you have not been there. I'm gonna switch to share. Okay. All right. If you haven't been here before on my website, all right, a little bit about me, my background. Like many people around here in the Bay Area, I'm a former engineer, and I wanted to get out of my cubicle and have time to do fun stuff. And they kept telling me, well, when I retire in 25 or 30 years, I'll have time to do all the stuff I want to do. And it felt like a sentence. And in 2005 is when I found trading as my way out of there. And I left Lockheed in 2009, knowing I had a way to generate income without having to sit in a cubicle. And that was great. And options was my first love, and then came futures and the currency futures, and then Forex, and then we went back to currency futures. So right now, 90% of my personal trades are currency futures. And then at certain times a year, like I said, in June, I'll be focusing more on options. Right now, I'm focusing more on futures because it's just cash flow, cash flow, cash flow. Got a couple of futures trades to place this afternoon also. A little bit about me, and there's a podcast where I got interviewed about my background and trading and my viewpoints and everything. Good to check out. Sectors we trade, a couple of the videos on strategies. And here is where we have the spreadsheets. This today's handout is from download, and here are the Dow, Nasdaq, and S&P trades over the last couple of years are here. So you can download that there. The last futures meetup we had. And for the different programs, these are the options program. A little bit further down for the futures. And my futures have now heavily focused on the currency futures, because you can trade those with a smaller account of a couple $1,000 smaller account and trade very effectively with a smaller account because we have micro futures. And it's a minimum, it averages 40 something, about 40% return for each first target trade on that average. So it's really, really, really profitable, easy to trade, very little effort involved, no day trading. Everything is done on daily charts, so it's just real easy trading. That's why we love futures. But we don't have the discounts online. You have to contact me, and I'll send you a special link for the discount, and you can use the contact form. You can email me off the contact form, or you got my email on the handout also. I'm going to put that in the chat window one more time so everyone has it, the link for everything. So unless there are any questions, we're going to call this a day, and then we're going to look at maybe having another presentation probably middle of June. So unless we have any questions right now, Olga?
Maybe next time, if not, to talk about the economic calendar, how you use it, and around the FOMC meetings, and not meetings, but the announcements regarding inflation and how that relates to the currency.
Okay, we'll take a look at some of the stuff there. And now, as you know, we're all technical traders, so it's not so much economic news, but knowing when certain things are going to be happening. And there are certain times to not hesitate to place a trade. And when we know something big is happening fundamentally and driving our trade signals. So we'll talk about that a little bit next time. We will talk about that a little bit next time. Cool.
Cool. Thanks.
All right.
Bye-bye. Good trading, everyone.
Talk to you soon, Olga. All right, so unless you have any questions, I'm going to end the meeting now, and then we'll resume again sometime mid-June, and we'll probably do futures mid-June and get it rolling. If you need to contact me, interested in coaching, let me know probably by this Wednesday, and then we get it all set up and going right away, because a lot of opportunities to jump on to the next bearish move. We've been in a bullish move so far, which means the next big move is down. We're just waiting for those sell signals to start happening. So, all right, so contact me soon and I'll be in touch with you guys. Have a good day.